you can't exactly see into the mind of other private investors, but I'm going to ask the question anyway. What do you think is the reason why it's quite a popular stock? Is it that attractive yield? Is that a comfort blanket for people?
Yeah, I think it's a bit like Samira, because when we talked about Samira, we mentioned then that there's a small army of UK investors in that one as well.
Yeah.
So I think it's the yield, it's cash rich. There's no debt on the balance sheet. Cash is about 45 pence per share, so it's 23 million pounds. So it's pretty good, and that can help shore up the dividend if there is a huge bear market around the corner. And it just looks attractive. The dividend record is pretty stable. It's a high yield, and UK investors do like their dividends and income. Welcome to the Private Investors Podcast, the podcast where keen stock pickers Mark Atkinson and Maynard Paton talk about managing their share portfolios. Mark began buying shares in 1984, while I started in 1993. This time we cover City of London investment and the investment potential of fund management. Let's get started.
So Maynard, lots of private investors are in a state of paralysis. Some have battle fatigue. Many are questioning or abandoning their strategies. Some have actually thrown in the towel and turned to fixed income. And yet against this backdrop, after something of a hiatus, you've been dormant for quite some while, you've been buying. So I'm interested.
Yeah, I've made my first share purchase for 18 months buying City of London Investment, ticker CLIG. This is a small fund manager, £200 million market cap, and it's a high margin, cash rich, prudently run business that when I was buying a few weeks ago, Mark, it was offering a 9% dividend yield. So it's a fund manager, so its profits have been hit by the market downturn, but the basic bull case is that if the markets can recover and the profits and the share price can get back to where they were last year, then there's a good chance of earning healthy double-digit returns, I think, from this investment over the next 3 to 5 years.
Yeah, so this is City of London Investment Group. There's a few similar surrounding companies, isn't there?
Yeah, there's another company called City of London, and there's an investment trust called City of London Investment Trust, but we're not talking about those two. It's a City of London Investment, ticker CLIG.
So how long have you held these?
I've held these for 11 years. So I bought initially at £3.55 in 2011. I bought more at £3.02 in 2012 and bought even more at £2.46 in 2013. I did sell a chunk of these shares in 2015, and looking back at my notes, I'd written down valuation fears. But since then, I'd never touched the holding for 7 years until the other week when I increased my holding, buying more shares at £3.53. So my average price is £2.99. So you're probably now thinking, Mark, if I first bought at £3.55 11 years ago, and the price I paid the other week was £3.53. It's been a very disappointing investment. It has for capital gains, but the dividends have been superb. So I reckon I've recouped 95% of my initial £3.55 investment through dividends, which includes the occasional special payout. And the purchase at £2.46, 2013, I've recouped more than 100%. Now I had to check my notes on this, but at the time of buying at £2.46, there was a 10% income, 10% dividend yield. It was paying out a 24p dividend. So it just goes to show that even if a share can offer a ultra high yield, the dividend can be maintained. It maintained that 24p dividend and increased it in recent years. So not every really high yield share value or an income trap. So at the moment, the share pays out 33p dividend, and I've been buying recently at £3.53. So that equates to a 9.3% income. So the shares did touch £5.50 last year. I think if the price can recover back to that, plus the 9% income, there's a strong possibility of healthy double-digit returns.
Yeah, we talk about total return, don't we? And this one, with those dividends that you've got back, in a way you could say that you're in the stock for nothing.
Yeah, this hasn't delivered capital gains as I expected, but it's not made a big song and dance about its dividends, but those dividends have just accumulated higher and higher. And looking back, really pleased and surprised, actually, I've got back my initial investment, especially from those £2.46 prices I paid. So yeah, it's been a worthwhile investment on that basis, certainly on an income basis.
So you moved back into City of London Investment Group. Was that one that for the portfolio, you thought that it offered compelling value, or was there an element of rebalancing your portfolio?
Yeah, it was a little bit of both. I think the valuation is compelling. It looks a straightforward investment at the moment, assuming markets rebound. If there's a huge bear market, I think this company will suffer, but the rest of my portfolio will suffer as well. But it's always been a sort of mid to low ranking member of my portfolio. I've got 11 shares at the moment, and it's always been position 8 for years, and now at a 5 to 6% weighting, but now it's at 9%. So it joins 6 other shares in my portfolio now with weightings of 9, 10, 11. So it's got much more influence on the portfolio now, which is what I like.
So where exactly do they invest their money?
They buy investment trusts. The strategy is quite simple. They buy investment trusts at a discount and hope the net asset value of trusts improve and the discount narrows. So let's say they find an investment trust with a net asset value of £1 per share. They'll buy it at, say, 70 pence, which is a good 30% discount. And they'll hope the net asset value improves to, say, something like £1.10, and the share price to go up to £1, which means the discount narrows considerably. So that's the theory. So it's a low risk approach to investing. It's like a value style, really cautious, low risk strategy of trying to buy £1 coins for 70 pence seems sensible enough. But the underlying assets can be volatile because the company has a long heritage of investing in emerging markets. So an extreme example this year is Russia. So City of London owned 26% of the JP Morgan Russian Securities Investment Trust, which is an investment trust listed on the London Exchange, gives UK investors exposure to Russian shares. So it owned 26% of this trust just before the Ukraine invasion. This trust has lost 90% of its value since. So to reduce the risk and dependence on emerging markets, the company is diversified. So it now invests into investment trusts on behalf of its clients in developed markets, which it calls its international strategy, so more mainstream Western markets, and also merged with Karpus Investment Management 2 years ago. So this is an American wealth manager which serves high net worth individuals. And that invests in a similar manner as well, investing in mutual funds at discounts. So that merger doubled the size of the business. So right now, at the last count, in terms of total client money, the emerging markets have about 38%, and the new diversified strategies have 23% of client money, and the Karpus wealth business, that has 39%.
Right. Well, I'm a bit wiser now. On this one, you went to another AGM. Did your purchase precede the AGM, or was it following it?
It was before the AGM, which is always a little bit of a risk, but thankfully there was nothing untoward disclosed during the meeting. The meeting was very different to System 1, which we discussed last time. So this time the board answered all the questions during the formal part of the meeting. So the Q&A lasted for 30 minutes. There was useful comments from the board throughout the meeting, which it was a very productive and informative meeting.
And is this one that you've attended before? Is it similar to previous meetings, or?
I've attended one 6 years ago, so
Right.
2016. It was similar sort of format, same room, same boardroom table, same number of directors outweighing the people who had attended. And it was, again, then they took all my questions. There was other people there that time who were asking questions. So I think that was a longer meeting. And yeah, they've got a good record. From these 2 AGMs, I actually received a letter from the former chief exec after the last AGM. We were talking about clients and clients paying fees, and he sent me a letter. I think he must have got my address from my stockbroker, but he did send a letter saying what he said at the meeting, which was a nice touch. So
Very nice.
That was Barry Oliffe, he was the founder of City of London, and he was the chief exec at the time, but he retired, I think, last year.
And I think he's still a major shareholder, isn't he, Barry?
He's been selling his shares over time. So I think he's now much smaller shareholder now. The main man now is George Karpus. The Karpus merger, he became the largest shareholder. He now owns 36%. I think he owns 31% personally, and 5% is related parties. He was there at the meeting. He owns 36%, a £70 million shareholding. One of the reasons for me to attend this meeting was to speak to George Karpus to see what he felt about the merger and his plans as well. In the annual report, there was some text that says George Karpus would provide an update regarding his future plans before the next AGM. So I wanted to know what his future plans were. So I did ask, what are your future plans? And I didn't expect a direct, clear answer. I thought they were just going to say, we'll announce them when we've decided. But the chairman said the intention is George Karpus will resign as a non-exec before the next AGM. And I thought, well, that's a shame, because as a small shareholder, I want the largest shareholder perhaps to stay on the board to keep the executives in check. It's a little bit of a shame he's retiring from non-exec. And he retired as an executive from Karpus at the merger 2 years ago. So that was the first phase, and I guess he's wanting out completely now. He's 77 years old. He lives in America. He's American. And I guess it's time for him to retire. He doesn't want to spend his time flying over to London for board meetings. So he did say he'd read my blog. This is the highlight of the meeting, was him saying, I read your blog and you were spot on about a couple of things.
Oh, wow. Brilliant.
So I thought, oh, wow, that's fantastic. So the largest shareholder, who clearly knows what he's talking about and knows the company inside out, he's saying I was spot on about my blog. So he didn't say what I was spot on about. He didn't specify that. But the fact that he enjoyed reading it, he said after the meeting, oh, I enjoyed reading it. You made some good observations. You were spot on a couple of things. I think, oh, sometimes I speak to management teams and get the impression that I'm either wrong or they're not quite appreciative of what I've written. But I'm pleased that George Karpus, at least, and the rest of the board, it seemed, read my stuff, and they were pleased that I'd written it. Yeah.
You mentioned about George stepping down from the board, but I would imagine with 36% of the stock, if he wants to pick the phone up, they're going to answer it, aren't they? If he's still going to have some clout, if he's still going to have access.
He has. The chief exec did say that George does whisper, which I guess means he will get on the phone and if things go wrong. I think looking at this merger prospectus, I think from memory, if he still owns 25% or more, he can appoint a non-exec on his behalf to represent him. So he does have that opportunity. But yes, he will have a direct line to the chief exec just in case things are not going to plan. The question is now is, he's got a £70 million investment. What's he going to do with that? He's 77 years old. Is he going to keep it? Is he going to sell it? Who knows? At the moment, it's paying him a £7 to £8 million dividend a year. Very nice. He was on at Karpus $15 million a year as a full-time executive. So his income's been a bit cut since the merger. So what's going to happen to his shareholding? I don't know. I didn't ask.
Yeah. Just on the merger, let's say 2 years ago now, do you feel like that has been digested now, or is that process of combining the two businesses together, is still that ongoing?
The merger process hasn't gone entirely to plan, which is a question I asked at the AGM. What's happened was, after the merger, in the subsequent 2 years, there's been more withdrawals than deposits. So money has been leaking out of this Karpus business, and new client money hasn't been coming in. So why is that? The disappointment is that in the merger document, they did say that the client money had at Karpus was $2 billion in 2011, and it had grown just at the time of the merger to $3.5 billion. So it did have a record of attracting new clients. But in the last 2 years since the merger, those clients have withdrawn money. So I did ask what's happened, and the management team did admit that the relation management team has not been consistent, which means I think the sales process wasn't up to scratch, and clients apparently took a step back from after the merger, which means they just wanted to double check that things were still being run the same way after the merger. And he also made a point about Karpus serving retail investors, and there's a suggestion that retail investors buy high and sell low. So in these rough market conditions we've seen this year, their clients have been selling at the wrong point. I think that was the implication there. The clients are mostly the individuals, high net worth, they're all American, and they take out $100 million a year just for their own income purposes. So they're fighting against that. And with rough markets and the pandemic as well, they've struggled to get the sales process working correctly at Karpus. So they did say next year they're aiming for more new client money to offset the withdrawals. But I'm not really expecting fireworks at that business next year. If they can just match the withdrawals with new client money coming in, that would be a success, I think. So yeah, I'm not expecting too much there. We'll see. It's been a little bit disappointing. And also the departure of George Karpus. He was an executive there, and then he's become a non-exec and he stepped back from day-to-day operations there. So maybe the clients and the staff perhaps have just thought things have changed a little bit. I don't know.
Yeah. Generally, mergers are quite difficult because it's new management, new personnel. All of a sudden, you find that you've got a new team leader and a new manager, and it's a change of culture. Generally, they take a little bit of time to bed down, don't they?
The founder of City of London, Barry Oliffe, apparently knew George Karpus for years. So they've known each other for years and got together with this merger. Presumably, George Karpus wanted to retire. Barry Oliffe, the founder, he retired the other years too. So they knew each other, similar sort of style of investing, but different clients. I should say the Karpus serves American individuals and City of London serves US institutions. So a different sort of client base, but a similar sort of way of investing in a low risk manner in investment trusts and mutual funds at a discount. Yeah, it's not been a total disaster, but it's just not had the progress which I thought was going to be apparent.
Yeah. One of the things I like about this business is that because it gets its income from funds under management, generally if it has some bad times, there's still going to be that income coming in. It's not going to disappear altogether, is it? That's going to keep chugging through those commissions. But against that, having said that, the long-term trend, and it's across all these kind of investment businesses, is the margins are being squeezed, aren't they? They're gradually be coming down. And that's been something with the City of Investment Group over the last several years. Yeah.
So the fees, they get paid every month or every quarter and based on the funds under management. So a lot of the clients, the institutional clients, have been there for years. About a third have been a client of City of London for 10 years. So the clients can be sticky. It's the same with Karpus as well. I think half of their clients have been there for 10 years. So the clients hang around for years, pay the fees based on how much they've got invested. So it's a great business that way, but you're right, the fees are being squeezed because of competition from trackers and cheap ETFs. So for City of London, when the company floated back in 2006, they were charging 90 basis points as fees. So if you invested £1,000, you'd pay £9 a year as fees to City of London. And a few years ago, that had dropped down to £8 a year. And last year, it was £7.30. So the direction of travel for fees is down. There's no escaping that. And that was mentioned at the meeting. I asked about fees. Why are they declining? Are they going to continue to decline? And they were very cagey about it. This was the only area they were a bit cagey about. So they would not disclose that much about fees, which tells me the whole topic of fees is sensitive. Presumably the clients negotiate a fee. It's all heading downwards. And part of the declining at City of London is because they've opened up new strategies which are cheaper than the old emerging market strategy. I think that charges a lot more than the new strategies, the developed market strategy they launched some time ago. So you've got that in the mix, but the general trend, as you say, is down.
I think a lot of people are a lot more aware now of the importance of keeping fees under control, and how that can, with compounding, that can really have an effect on your portfolio. And you look at the emergence about Vanguard. I think in the United States in 2010, of the funds, Vanguard was our passive trackers was about 20% of all funds. And 10 years later in 2010, it's gone up to 40%. So that's a massive change, isn't it? And these actual active fund managers are being squeezed. The meeting was down in the City of London, City of London Investment Group. When I go down to the City of London, I go down on the train, I drop my case off at my hotel, and I make a beeline to Leadenhall Market. I have a pint of bitter in the Lamb Tavern. And then people start spilling out of these offices, these opulent offices, and they're very well turned out. They're generally wearing a watch that's better than the one that I've got on. There's the chink of martini glasses and popping of champagne corks. And you hear the conversations. These are people in the industries that are being funded by all these commissions that investors are paying. Yeah. So you got to see it firsthand where all this money is going.
Yeah, it's very much not a sector for thin cats. It's not my favorite industry, because you're being squeezed at the top because of client fees coming down and with trackers. But also you're being squeezed the other way with costs, which is wages for your staff. The big cost for any fund manager is staff. The cost of your staff seems to go up every year, regardless of the returns for your clients. If client money goes down in the bear market, yeah, okay, but your staff always seem to get paid the same or a bit more every year. So the gap in the middle is what's left for shareholders. So revenue under pressure from clients, your costs under pressure from greater wages, your profit for shareholders consistently being squeezed over time. Yeah, I've looked at different fund managers for SharePad. So I looked at Ashmore for articles for SharePad. So written about Ashmore, Polar, Impacts, Line Trust, Jupiter. And they're all the same, where the staff all seem to get paid a little bit more each year, regardless of whether the clients have made money or not. One thing of this sector, is it run for the benefit of the clients? Is it run for the benefit of the shareholders? Or is it run for the benefit of the staff? And you do think sometimes, yeah, the staff take a little bit more than perhaps they should. But having said that, the economics of fund management are great. City of London, even though the client fees are under pressure and the wages seem to go up every year, it generated a 40% margin last year. And this was in a rough time with the stock market. So a 40% margin is fantastic. The Karpus business generates a 50% margin. So it's still a really lucrative business for shareholders if you get it right. And even if you get it not so right, shareholders can still make some good money. So, I mean, I take a pragmatic approach to pay, and it is what it is at City of London Investment. They say the staff pay arrangements work, it encourages the right sort of culture, and it works for shareholders, clients, and the employees. So I accept it. So the choice is you either accept it or don't invest in the sector. And I look at buying with a 9% income yield, and I think, okay, that soothes a lot of concerns, let's say, about staff pay. Yeah. I did work out the average employee at City of London over the last few years has taken home £160,000, and the top men take home nearly £1 million a year. So, yeah, it's not a sector for thin cats.
I believe they've got a particularly interesting KPI at City of London Investment Group.
Yes, this is interesting. This is a share price KPI. So very few companies have a public share price KPI or even talk about the share price. But City of London, their KPI is based on the share price, and it's between 7.5% and 12.5% over 5 years. So if you buy the shares, you should get, let's say their aim is to deliver a 10%, which is the average of that range, 10% compound annual return over 5 years, which tells me that the management are focused on shareholder returns. It's not just governing assets or paying the staff, they are focused on shareholders as well. So 10%, that's the expected rate of growth. So if you think back, you can generally get 6% income on this share, and the funds under management perhaps are growing at 3%. So it's 9%, 10%. That's the way of looking at it. But at the moment, the share price is down, we're in a bear market, and I reckon that in a favourable market recovery, you can get well over 12.5% compound over 5 years. I'm looking at sort of 15% compound returns over 5 years. So, yeah.
In order to achieve that KPI, is there any share buybacks, and are they retiring any stock?
No, there's no share buybacks. They just buy a few shares back every year for the staff, for their options. There's no share buybacks. There's nothing like that.
I had a good look through the report, Maynard. In fact, the corporate governance, it spans 42 pages.
Yes, 42 pages. So I picked up a copy of the annual report on the way out of the meeting, and I was reading this on the train back home. And it just struck me that there's lots of text in the annual report about corporate governance, about the remuneration report, audit report, all that sort of thing, corporate governance code. So 42 pages. When I got home, I looked at the System 1 annual report, and that was just 14. And I thought about it, compared the different meetings, and it just showed that they take corporate governance a lot more seriously. And that was reflected by the AGM, where everyone was there and they answered all my questions and would have sat there for, I think, another half an hour answering even more questions. They took it all more professionally. Whereas System 1, they had 14 pages in their annual report and didn't perhaps take the meeting as serious or professionally as they could have done. So that may be because City of London are main market listed. They're on the main market, so they have to disclose more corporate governance text than System 1, which is AIM listed. But I just thought it was an interesting point, actually, that nobody reads corporate governance text, but perhaps it is important because the management that do go to some detail, talking about how they run the business. They perhaps care more about shareholders than those that don't.
Perhaps it's just an indication of the culture.
Yeah, that's right.
It's quite interesting that when I look at your portfolio, you're not investing in any investment trusts, but you're investing in the business that sells them.
Yeah, I think you can make better money from the fund manager than the funds themselves. Yeah, if you're going to be investing in this sector, you might as well invest in the funds, I think. The staff, they are, how can I put this? They want to get paid. So you want to be on their side perhaps than the client. It sounds unfair, but I'm hoping to make a return. It's a different balancing act. All these fund managers are balancing act between the clients, the staff, and the shareholder. Some fund managers, their share price has gone up 10 times. You look at Lion Trust and Impacts Asset Management. I don't think any of their funds have gone up 10 times in the last 10 years, but their share prices have. So that tells you you should be investing in the fund manager and perhaps not their funds.
Yeah. If we see margins continue to be squeezed, then some fat's going to have to be trimmed from this industry, and it's probably going to end up in consolidation, wouldn't you say?
I would. There's all sorts of acquisitions and mergers. So Lion Trust, that's one example, and that's been buying up smaller asset management. The whole business is quite scalable. You've just got a few stock pickers there and a few computers in an office. You get more assets under management, and you don't need that much more staff to manage the extra client money. So the margins should improve. But the clients are paying less, so that offsets the economies of scale. But it is an industry where it is quite straightforward to just buy another asset manager and trim out some of the fat.
To be fair to the employees, when you look at the report, one of the good statistic actually is their employee retention, which actually to flag that as a major kind of achievement. So obviously they consider that the employees are a core part of the business, and that if they have flight risk of employees, then it's not just a case of getting somebody else sat at a desk, that those employees know what they're doing, because if you've got somebody in that position that doesn't know what they're doing, it can be very expensive.
Yeah, so they have a team approach. So there's no superstar fund managers here. So this reduces the risk. So they have a low risk approach to investing, and also in terms of who they employ. So it's a team-based approach. They don't have a Terry Smith there, and they don't have a Neil Woodford there. So that could be good or bad. They don't have Neil Woodford there who could blow up their fund, but they don't have a Terry Smith there who could work miracles in the stock market, attract new clients through fantastic returns and generate huge fees. So on balance, it's a low risk employment strategy. It seems to work for them, at least. And the clients are quite happy. A lot of the clients have been around there for years. And a lot of the staff have been, as you say, have been employed there for years. And the argument against that perhaps is that it's a little bit of a sleepy business, whereas the staff have got very comfortable investing in the same manner for years. The clients have got very comfortable investing in the same manner for years, and there's no sort of ambition to expand the business and find new clients, or perhaps a different way of investing that may attract new clients, new money, drive funds under management higher over time. One of the criticisms of this business, which I think perhaps George Karpus picked up in my blog, was there's not been much growth over time in terms of funds under management. When I bought the shares back in 2011 for the first time, funds under management were $6 billion. And 9 years later, at the time of the merger, 2020, funds under management were $6 billion. So I bought it, looking back, bought at a peak in terms of the amount of client money they had. They lost a big mandate pretty much the day after I started buying. And the funds under management had dropped from 6 billion, almost 6 billion, to 3.5 by 2016. We talked about the share price. It effectively has been flat for 10 years. And you think, why? It's because they've not attracted new clients and driven funds under management higher to drive greater fees and profits. If you go back to Lion Trust again, 10 years ago, that had funds under management of 1 or 2 billion. And you look now, it's more than 30 billion pounds. That's all through good returns, good marketing and acquisition. So they seem to be much more dynamic in terms of attracting new client money. And Lion Trust has been a 10-bagger, 15-bagger at some point over the last decade. But it's a different style of investing. And they've got perhaps different issues in the years ahead in terms of how they invest compared to City of London. One thing about City of London is that the client money is still coming in overall. So even though it's perhaps leaking out of the Karpus business, it's still coming in at the City of London business. And so for the last 4 quarters, there's been more deposits from new client money than withdrawals, which is very encouraging given the rough markets, because most fund managers, or at least some, they've been seeing large withdrawals. They deal with retail investors who notoriously buy high and sell low. So the market's down and they want to sell out. So they're struggling with withdrawals. Whereas with City of London, their institutions, they're putting money in. So that's encouraging. So yeah, maybe these difficult market conditions are more suitable for City of London's investment style, where it's more of a value approach, more sensible approach to investing. So to be honest, it doesn't have to grow that much. It just needs the market rebound. If the market goes up over the next few years and just gets back to what it was. Last year, funds under management total were $11 billion. And the last statement said it had fallen down to between $8.5 billion. So it's down about 20%. So you just need the market to rebound back to where it was last year, and funds under management to get back to $11 billion. Yeah. And you could get back to the share price at £5.50.
Yeah. I mean, you mentioned the trend of the funds under management over the last decade or so, but that's just, as we said earlier, running parallel to that has been that people gravitating to those tracker funds. And as that's been growing, these active fund managers are going to be competing for a smaller pool, aren't they?
There was an interesting chart in the last annual report, which I raised this at the meeting. So this chart in the annual report compares the S&P 500 to the emerging market benchmark that City of London use. And it shows the S&P 500 completely trouncing this emerging market benchmark. So I asked, surely there are going to be some clients who are thinking, what am I doing investing in emerging markets and not in the S&P 500? And they did admit that in some client trustee meetings, they have asked that question. What am I doing investing in emerging markets? So yeah, they've said that the prudent clients still want exposure to other asset classes. One point they did stress was that institutional clients don't go all in into one asset class. So they're not all going to say, forget about active management, we'll just put it all into a global tracker. Apparently that's not going to happen, or at least with City of London Investments clients. They said a core of clients still want diversification. So they'll still want some emerging market exposure to, say, other assets such as private equity or small caps in the States, something like that. So that's what they say. But us as retail investors, we could say, let's forget about stock picking. I'll put it all into a global tracker and do something else. Apparently that doesn't happen among institutions, or at least this company's clients. They did stress during the meeting about allocators and buckets. They use this terminology, allocators and buckets. So your allocator who works at the institution will say, I'll allocate 5% to emerging markets and 10% to private equity. They talked about these buckets, and when the bucket becomes full, your emerging market bucket becomes full at 5% or 6% or 7%. They'll take some of that money off the bucket and put it into an empty bucket, Japanese shares or something like that. Yeah, so it doesn't work like retail investors. So we think differently to these institutions. But you can't help but feel some of these trustees of these institutions are thinking, what are you doing earning a few percent a year in emerging markets? Because that's what it's been, when the S&P 500 has been marching ahead relentlessly over the past decade.
Yeah, just going back onto the trackers, that's been raised. There'll be some high water mark at some stage. I don't know where that's going to be. If we end up going to 100% that being done by trackers, I think there'll always be need for some human element of investing in the market.
Yeah, it won't go to 100% because there'll always be someone will think, okay, I can spot opportunities now. So the more involved trackers are, there's going to be more buying opportunities for anyone who can study shares in any depth and spot more buying opportunities, because otherwise these computers buying shares all the time for trackers. I don't think it's going to be completely disrupted, but it's putting pressure on the whole industry in terms of fees. And if you're going to set up a fund management business, you've got to outperform. You've got to be a Terry Smith type investor who actually delivers outperformance on a reasonably consistent basis. Otherwise, you think, I might as well just put it in a global tracker. At the meeting, I asked about emerging markets and why would you invest in emerging markets now? And they did say that the discounts on investment trusts in emerging markets are now at their widest for 18 to 20 years. And it's historically really cheap. If you look back through a lot of the annual reports, they do say, oh, emerging markets are cheap. They always say that compared to developed markets. But they were pretty bullish on the discounts available now in emerging markets. So they did say things can't go up forever, which suggests that they think the S&P 500 will mean revert and perhaps the emerging markets will start outperforming, but we'll see. Yeah, they're bullish on emerging markets as you'd expect.
Yeah, just going back to the AGM, and there was just two people there. I thought there might have been some more private investors there, because looking at the major shareholders, there's a large element of private shareholders in their base.
I think there's about £30 million owned by private shareholders through the stockbrokers, the popular UK stockbrokers. So it's a bit of a shame there's two private investors turned up and only one me asked questions. I think there was some private investors there last year, and the AGM I went to 6 years ago, there was a few there as well. But this is a problem with all AGMs, isn't it? Private investors just don't turn up, which is very sad. But if you go to these meetings, so I had effectively the whole board there for 30 minutes, and I could have been there an hour because they were really, really helpful and wanted to talk about the business. I had 9 or 10 questions, but you never know when you go to these meetings who else is going to be there and how willing the chairman is going to conduct the meeting. As we saw with System 1, I could have been there for an hour, and it's a great opportunity to grill all management, and you see the interaction between the non-execs and the execs. And I spoke to George Karpus. Now, he's not going to be there next year, it seems. So it was the only opportunity to speak to him and get his feelings on how the business is. It's the merger. So yeah, it's a great opportunity, and more people should go to these meetings.
You can't exactly see into the mind of other private investors, but I'm going to ask the question anyway. What do you think is the reason why it's quite a popular stock? Is it that attractive yield? Is that a comfort blanket for people?
Yeah, I think it's a bit like Samira, because when we talked about Samira, we mentioned then that there's a small army of UK investors in that one as well. Yeah. So I think it's the yield, it's cash rich. There's no debt on the balance sheet. Cash is about 45 pence per share, so it's £23 million. So it's pretty good, and that can help shore up the dividend if there is a huge bear market around the corner. And it just looks attractive. The dividend record is pretty stable. It's a high yield, and UK investors do like their dividends and income. And yeah, I think that's the reason why.
So it's several years since you've topped up, you last traded on this one. Is that going to be it now for another half a decade or what? Or do you think it could be having a further look at it in the near future?
I would buy more. I think if it dropped back down to £3.50, £3.60, I'd buy more. It only dropped down to that sort of level for a few days. So I didn't really have much chance to really go really big on it. But the shares are now £4. So if it drops back down to £3.50, £3.60, I'd probably buy some more. I think with a favourable market rebound over the next few years, you could get that income plus a reasonable capital gain as well.
Yeah, I can certainly understand why you hold this. And I think if I had a vacancy in my portfolio, I'd be looking at this one as well. It's one that I would describe as ballast. It gives your portfolio some stability. It's a bit like a football team, isn't it? You've got your goalkeeper and you've got your defenders and your holding midfielders. They're offering you some defence, aren't you? First and foremost, if you don't let a goal in, you're not going to get beat. You can't all have the stars in your portfolio, but they can get the Man of the Match award. But this is one that I'm going to watch closely now, and it's one that could make its way in.
It's quite straightforward, I think. You've got to believe in the dividend, and you can accept the fund management business. It doesn't need anything special. It doesn't have to launch a new product or do anything radical. It just needs the broader markets to recover a little bit from the last year or so. And then you could get, I think, decent double-digit returns. And if the market stabilizes from this lower level and funds under management stay at between $8 and $9 billion, I think you'll still get the 33 pence dividend. I reckon if funds under management stabilise now at this lower level, then earnings should be about 36 pence. Yeah. I mean, it fluctuates a bit because all the clients are American, so everything gets paid in dollars. So if the dollar strengthens, it benefits. That's something to consider. But I reckon earnings are about 36p, running at 36 pence per share at the moment. So the dividend's covered. So assuming things don't change, you're going to get a 9% yield, I think. Yeah, well, that dividend offers you some comfort, and you're being paid to wait, aren't you? I should say this share has always looked cheap. So you're thinking, 9% yield. And I did mention earlier on, I bought it at a 10% yield some years ago. So when you look back at the share pad charts of the trailing yield. And you could have bought at any random time in the last 10 years and you'd have got a 6% income. So it's always traded at a high income yield, and the PE has always been between 10 or 11 or 12.
Yeah.
So it's always looked cheap. It's paid out a lot of its earnings as a dividend because it doesn't need to reinvest them. And the rating has always been between 10, 11 or 12 because it's not really grown that much in terms of client money. What's going to drive this business forward? A market rebound, but one day maybe it can attract a lot more client money. Going back to Lion Trust again, that was rated at 20, 30 times earnings last year. Why? Because it was attracting lots of new clients. It was generating sort of 15% growth every year in terms of its funds under management, purely through new clients coming on board. Whereas at City of London, it's been about 3%. And the market's not going to pay a premium rating for 3% growth. So that's why the shares have always looked cheap. But you get this fantastic dividend, which if you hold for long enough, can repay your entire investment, as I've shown.
Yeah, and I would imagine at the bottom end, there is a level of support in that somebody would potentially take them out.
Yes, I wonder what George Karpus is thinking. What's his plans for his shareholding? So yeah, there must be a larger business around who invest in a similar sort of way, may have got their eye on them. They did say in the annual report, the chairman says bear markets do produce opportunities for acquisitions. I read that as them buying another asset manager, but maybe it's sending out a signal to potential purchases. I don't know. But yeah, if you've got a fund manager with lots of money, bear markets are good for purchasing struggling asset managers. Well, that's it for this time. Thanks for listening to the Private Investors Podcast. If you enjoyed the podcast, please let us know by liking, subscribing, or even leaving a review. Until next time, thank you and goodbye.
They really have. It's really
down to
people
zero. So yeah. So
I think it's just, this is how these markets work, whereby people get in at the top when the euphoria is there. And this is exactly the moments where people think, wait to see if it starts going up. And if it goes up like 5-10% and the confidence is back in, then I'll get back into the market. And that's where you miss out on the returns. It really is. And it was life-changing for us.
Well, there's something. It's life-changing. That's what investment's all about, changing your life and making a better life. And if you've invested in something in a big way and it's come off, then you say, yeah, it's changed my life. Yeah, I've had life-changing investments. I bought shares London Stock Exchange years ago, and I put a third of my portfolio in London Stock Exchange, and that went up 5 times or something. So I think, I can eventually bought a house with all that mortgage free. So you think it's changed your life. There are very few investors who want to look at reports and try and do their own work and find these great investments by themselves, because you can just put it in a fund or a tracker. Some people do that, put it in a tracker and think, okay, I spend a few hours at the weekend trying to find a high risk punt. And that's it for 2% of my portfolio.